So we do have a quorum, so I'm going to call the meeting to order. Reminding everyone that we are streaming and we are on YouTube. First order of business is approval of the minutes of the Finance Committee meeting of May 28th, 2025.
Second.
All those in favor?
All right.
Any opposed? Any abstentions? At this time, I would ask Dr. Walker to introduce our new committee member, Mr. Bob Glick, who will be serving as advisory on the Finance Committee. Turn it over to you, Dr. Walker.
Thank you. So I'm sure all of you know Mr. Glick. He's been around the hospital. He's been a great aid to us. We are going to take this opportunity to thank him for his support and expertise he's been providing for this hospital. As most of you know, Bob and his wife Joanne joined our mental health family in 2020, and they made the largest gift in the hospital's nearly 200-year history. Our state-of-the-art hospital is named in recognition of their transformational $42 million gift. But over time, and I know this personally from talking to both Bob and his wife, they've been much more interested in engaging with the mental health staff and walking through the halls, shaking hands, and attending our Employee Appreciation Day and even watching our talent shows. Joanne also serves on the Mental Health Foundation Board of Directors. He has long desired, he's talked to me and others about adding his business expertise to the hospital in addition to his financial giving. And after talking with our chief legal officer, we've determined that Mr. Glick can serve as a non-voting advisory member of the Finance Committee. We're grateful, and I am grateful for his willingness to offer his expertise. So I want to thank Bob and his wife for his support and welcome him to our committee.
Thank you, Bob. Thank you, Dr. Walker. I'm now going to turn it over to Clearstead, Mr. Blake and Mr. Strickland regarding our investment report. Blake?
We have a number of items to get through. It's on the second page here of the presentation. We have good news to share, so hopefully that's well received. And as we look at the agenda of items we want to cover, the dashboard, capital markets, performance, we want to go through those first three a little bit quicker, so we have time to talk about some action items that are going to be proposed to the committee for number 4, rebalancing the system investment portfolio and the captive investment portfolio. With that, I'll move into the oversight dashboard. So as many of you have seen, this is the overall game plan as it relates to the investments. Some important items to review over the course of the year, and we continue to follow this game plan. We've met several times with Jeff and his team since the last time we were in front of this committee. So things continue to move very smoothly. And the next time we'll be together would be on October 22nd. So moving into the capital markets review, slide 5. A lot of information here, but to highlight some things, what we saw in the first quarter of the calendar year was the economy appeared to slow down a little bit. And then in the second quarter, the economy appeared to pick up a little bit. There was some nuance in those GDP numbers. But the key takeaway is we've grown at a pace that's a little bit slower than what we would have expected at the start of the year, but it is still growth. We're not forecasting a recession. I'll come back to that thought a little bit later. So that's the good news. Also, the consumer and corporations overall look fairly healthy. Also, just as you think about capital markets and the positive impact they've had on the system that David will get into here in a little bit, we did see those Magnificent 7 stocks really accelerate again in the second quarter. They pulled back in the first quarter, and as a reminder, when we look at results today, back in early April, we were hitting bear market territory. So the markets had pulled back 20% from peak to trough, and then now we're essentially at all-time highs. International stocks have done the best this year. That's primarily due to the dollar weakening. But your international investments up around 20% in the first half of the year. The economy overall looks stable. The economy also hinges on the labor market. And the reason I say that is if the consumer is employed, generally they're going to be in a position to spend, and that's where our economic growth comes from. So the unemployment rate is very low. It's expected to rise a little bit based on the Fed expectations, but keeping a close eye on that. The Fed did come out and make some comments, the Fed chair last Friday. And seemingly, if you saw the markets were excited because the Fed is starting to concede, yes, it's probably time to start cutting rates. So the market's anticipating a 25 basis point cut in September and in December. Equity market sentiment is notably positive, much more positive today than where it was a quarter ago. The system, as you'll see coming up, has benefited from that. And then, of course, geopolitical risks remain. I'll skip slide 6 and go to slide 7. So when you look at Fed expectations from March to June, a little bit lower GDP growth, a little bit higher unemployment rate expected by the end of the calendar year, and a little bit higher inflation. But still the Fed projecting 25 basis point cuts by the end of the year. Going along with that theme on slide 8. One more slide, please. The Fed's dilemma, inflation, labor market growth, and some of these forces are going against one another. So the Fed's really trying to walk a line, but what we're seeing is some modest improvement in both inflation and growth. We did see some weakness in the labor market in the last few weeks. So that's something we're keeping a close eye on. Slide 9 is looking at equity market valuations. So this is some of the growth we've seen in the equity markets has been because earnings have grown, but also what's happening is multiples have risen. And some of that has to do with those top 7 stocks that I mentioned. But coming off of the second quarter earnings season, it was actually a very good quarter for earnings. So about 81% of companies beat expectations. That's higher than the average rate of 75%. And this would be about a 12% growth rate over the second quarter of 2024. Also, I thought this was interesting to note in the first quarter, and think about the timing of this, things weren't looking as good. There was a 87% decline in the word recession in earnings reports between the second quarter and the first quarter. We live in a world where a few words, everybody's paying close attention to. So a lot of corporations feeling better and not mentioning recession in their earnings discussions. And then lastly, slide 10, the yield curve has steepened. The Fed is influencing the short end of the curve. The market on the long end is thinking about growing national debt. So we've seen some upward lift in long-term rates. But the movement that we've seen here recently has benefited the system. You'll see your fixed income investments have done well in the last couple of quarters. All right. Any questions before I turn it over to David? Talk about performance.
No questions? Great. So let's move to slide 13. So start with the governance here. I'm sorry, slide 12. Slide 12. Start with governance. As the system, this looks at the system in terms of in compliance with investment policy and Ohio revised code. You can see, we have green boxes with yes across the board, so no concerns there. The system was in compliance with both the investment policy and Ohio revised code over the quarter. Slide 13. As a reminder, ClearSet follows a disciplined process evaluating investment managers. This shows you, the overview of the guidelines. In slide 14, go to the next slide here. This is just our watch list dashboard. And as you can, the bottom line here is that all of our active managers are performing well, and there's no concerns from our active managers. Slide 15. Slide 15, this gives you a snapshot of all the system assets broken as of 6/30/2025. And it's broken down by the system and captive and the reserve and non-reserve pool. You can see the total system assets of $648 million at the end of the June 30th. I do want to point out the reserve pool You can see down at the bottom left there, assets of and cash and unrestricted investments of 337 million. That's, as you remember at our last meeting, that was slightly below the 300 million. We have since replenished that pool. Now it's above that 300 million threshold at 373 million. On to the next slide, slide 16. This shows you the system attribution of market value change. And we break that down. If you look at the bottom box there, it shows you the starting balance in the quarter of 467 million, and then the change over the quarter. One thing I want to point out there in the non-reserve pool, there's $85 million that was raised from short-term bond funds for cash needs for the system. Adam's going to talk a little bit more about that as we go into the rebalance recommendation. But you can see in terms of, investment results have been strong. You can see the net investment change for the system up almost 20 million on the quarter alone for an ending balance of 442 million. Slide 17 gives you in the performance results for the quarter across the breakdown of assets that the pool is invested in. You can see strong quarterly performance. The top line there, 4.6%, year to date, 4.7%. And as Adam alluded to, this has been a real strong turnaround for investments, and particularly within equity markets. As markets have rebounded back and we're sitting at equity markets near all-time highs. If you also look at the long-term results, strong long-term results, so those, the trailing 1 through 5 year periods. And if you break down, as Adam alluded to, some of those numbers there, I want to point out, total international equity had a really strong performance. You look down there at about middle of the page of year-to-date performance of 20%. So being diversified within equities has benefited the portfolio. We've seen a rebound in U.S. equities as well. And if you look below at the bottom, breaking down the short-term pool and reserve pool within the fixed income bucket, being in a higher interest rate environment, that's benefited, fixed income markets. And so it's providing stable, steady returns for the system. Lastly, I'm going to cover slide 18, which covers the captive. You get same thing here in terms of layout for the market value change for the captive, starting a balance of about 108 million. You can see, minimal withdrawals from the captive and a net investment change of 6.8 million on the quarter. So same results here, strong performance results for the captive on the quarter. Any questions there on terms of performance results?
A different question, not on the performance results, my board members. Is this captive number a public number?
Yes.
So every plaintiff's attorney knows we have this number. I mean, that's a question, right? They do.
The meeting is public right now.
I will pass it back to Adam.
So on slide 20, this would be an action item coming up for the committee. This is a snapshot of the system investments through August 18th. So this goes into the third quarter a little bit. So the first thing I'll note is the equity investments are up an additional $4 million in the third quarter. So off to a good start for the quarter. But what we're looking at here, if you look down at the recommendations, is we're looking to take and rebalance the portfolio a little bit back to the way it was positioned at the onset of the investment program. So back in 2018, when the system began to invest in the non-reserve pool, 75 million was allocated to the non-reserve pool, which is equity, and then the balance in fixed income and cash. So that was about a 19% equity exposure. Going from 2018 through today, that 75 million has grown to 163 million. So there's been about $88 million in gains unrealized gains. And that equity proportion has grown from 19% to 25%. So what our suggestion for the committee is, we've been in touch with trustee Moss and Jeff, is to take $30 million out of the non-reserve long-term pool and replenish those short-term bond funds. So it remains in the non-reserve pool, but to replenish the short-term bond funds with Lord Abbott and Vanguard ultra short-term. And what that does is it brings the equity allocation back down to about 20%. So we're viewing this as a rebalancing of the portfolio. And and also recognizing the gains and the decisions that this group has made have been beneficial. So, John, anything you'd like to add to that?
I don't want to interrupt. Are you going to talk about a little bit more about captive? Is that coming up?
We'll do that in the next, yep, it's coming up.
So, but anyway, bottom line, no one's making any predictions on where the stock market's going. It's just we've made this so much money. Two, our needs have changed, or equity should be in long term, and because of some of the situations we have, we're protecting some of our profits.
Yeah, I mean, I would just say that will make it, well, first of all, kudos to the decision makers that, invested when they did. They've done very, very well. We're garnering some of that now and putting it back into a fixed income pool where if we need to convert it to cash, it's much easier to convert it to cash. And that could come up at a time when it would be ill-advised to sell equities. So this protects us a little bit.
If you recall back after the first quarter, when the stock market dropped, our cash flow, our cash position dropped, obviously, so we're tied to the markets. That market's been helping us out on our cash on hand because of them.
Pull a little bit out, safer.
Yeah.
Yes.
I don't know if that requires an action item.
Do we,
Do it now or?
I don't think it requires an action. I think that was given to the internal management and investment committee.
I think we should recommend it.
So we brought it here and yeah, we'd like to.
so do we want do we have a motion to recommend the rebalancing back to 20% equity in the non-reserve pool?
So moved.
Second.
All those in favor?
Aye.
Aye.
And any abstain? So the motion passes. Thank you.
All right, thank you.
Thank you. And on the next schedule, this is the captive. So the captive, David talked about it in the snapshot. There's around $118 million invested in the captive. There's also some cash that sits outside of the investment portfolio. The captive has also done well because of the markets. There's about a 50-50 balance between stocks and bonds and alternatives in the captive. And given the gains in the equity markets, we're simply looking to rebalance back to target. So the $4.5 million that you see outlined here is reducing the equity allocation from 53% to 50%. So that would be our recommendation.
So the if you look back, the captive we started like 50 million, 55 million, now it's 118 million. Two things. One, the captive is the lawsuits are not affected by the captive, yes or no? Who can
What do you mean?
What do you mean?
if we lose like a defamation suit, does that come out of the captive?
No, defamation would.
Not defamation.
Okay, so just
It's not
But-
reserved for lawsuits.
It is reserved.
For medical lawsuits.
For medical lawsuit, yes, for medical lawsuit, not defamation.
So any of these, all other lawsuits are out there. This is not part of that. And two, the captive is actually governed by, there's another board that oversees captive.
Yes.
Yes.
And maybe would it be prudent to recommend that since it's going for 55, what point do we have too much in captive, right? So we can claw some of that back.
We've done that before too.
Yeah, so, I mean, the primary insured for the captive is obviously Metro Health System. We pay premiums into the captive every year for different lines of coverage. Most prominently the medical malpractice. our hospital professional liability. And we have in the past, not paid in our premiums, and the captive has taken gains from the investments to use for the premiums. And we are going to recommend that we do that again this year.
So that saves the system funds from not having to pay that.
And does that go to the captive board? Is that how?
Yes.
You tell them, so stop premiums or slow down premiums, and that will save the
We
hospital.
have representatives on the board. I'm one of them.
Okay.
Darlene.
They're just not gonna, if they're gonna leave that alone, just take stop premiums.
Is it gonna stop premiums or is it going to take premiums from this funding?
There will be a reduction.
Okay.
Mr. Blake, any other questions?
The last item we have is the annual fee review. So the system is on slide 23. And just as we've shown the group in the past, we're simply laying out each investment in the portfolio, what its expense ratio is. And then where there's a comparable benchmark for that type of investment, we have that listed in the right-hand side. Keep in mind of the non-reserved long-term pool, about 65% of it is passively managed in index funds. And that's a reflection of our belief on the efficiency of capital markets in the areas where you're passive. And it's also keeping your costs low. So on the bottom of that slide, the total investment management fees come to 0.14%. The consulting fee to Clearstead comes to 0.03%. So the total fee is 0.17%. We think that's very low from what we see in the industry. And this is about the same level where it was last year this time. And then similarly on slide 24, these are the captive investments, a little bit of a different mix. Keep in mind the captive doesn't have the larger Ohio Revised Code cash-like investments. So the investment management fees are a little bit higher. So 0.40 on the investment management, consulting at 0.03. So total fees at 0.43%. We also think that that's highly competitive. That trustee Moss, that concludes our investment update. We're happy to answer any questions.
Questions for Clearstead on the question before I turn it over to Mr. Himes? Yep, take it over and give us the update for the second quarter of 2025.
All right, great. Brian,
Brian, yeah. Brian, are you gonna upload Mr. Hines' slides, please?
thanks, Adam.
Thank you.
All right, great, thank you. Next slide. All right, so this is the June 30th finance update for the committee. This is the same slide that is typically in there as matters for board attention. It gives you a nice high-level overview of some of the highlights for the first 6 months of the year. Next slide. So this is our trended discharges and observations. You can see, we've grown since prior year, a little short of budget on the discharge side. We are very, very close in total, but the big gain was in observations. And as you know, while they use resources like an inpatient stay, they unfortunately do not reimburse us like an inpatient stay. Next slide. These are our emergency visit volumes, significant growth year over year here. They beat the budget, they beat prior year by a significant amount. And just as a reminder for the committee, almost 82% of our inpatient stays come through the emergency department. So key for us. Next slide, please. These are our total surgical cases, inpatient and outpatient. You You can see the concern we have here is weak spot is in our inpatient discharges. You know, trailing prior year and not at the budget target. You know, we're doing a significant deep dive into that and trying to understand where we have lost track there. I know we've had some physicians out and some other concerns, but that's certainly a spot for us to do a little bit deeper dive into. On the outpatient side, however, you can see we're significantly up, growing strong since prior year and beating the budgeted targets as well. So all in, surgical cases are up year over year. Next slide, please. These are our outpatient visits trended, and again, you know, growing pretty substantially. In-person and telehealth visits are up compared to prior year and the budget. It looked like June was down a bit on the trend, but if you looked at prior years, also June was a month where they seemed to drop off a little bit. So not a big concern there. Next slide. This, of course, is fairly robust and happy slide as we have seen year over year. Again, we continue to climb in the number of prescriptions filled and even probably more importantly in the capture rate. So the capture rate continues to climb. It's up almost 12 points over the last 2 years. So really solid performance, keeping things in now. And of course, we'll see when we get to the financials what that does for us. Next slide, please. So this slide, I think, last quarter was perhaps in the appendix. I pulled this forward just so that we'd have an opportunity to talk a little bit about, well, our payer mix on gross charges, of course, and you can see trended over time how, you know, which groupings have gone up, which ones have gone down. You can see Medicaid is actually on a gross charge basis shrinking. But if you look at the very bottom piece, that's our self-pay category. And you can see how that for the first 2 years was dropping, went from 5.2 down to 5, down to 4.9% of our total payer mix. And then it shot up to 5.8 and then up to 6.8. We're trending for 2025. And, you know, just for line of sight, I add to the bottom the gross charity care for each of those years. So you can see back in 2021, we were at about 176 million. It stayed that way in 2022. It went up a little bit in 23. And then that's when it really, as our self-pay volume grew, our charity care write-offs grew substantially, you know, up 75 million in 24. And that's a six months number for 2025. So if you double that, it looks like we're going to be about 375. We'll be up $100 million from last year. So not insignificant hurdle for us to tackle and to overcome.
And that number, those numbers, that's not based on our charge, it's growth.
It is based on our charge. It is our charge. It is actual gross charges.
And I may add that the commercial, although you see the increase in the commercial volume, a lot of this is marketplace increase in volume, which also translate into charity care.
Okay.
Yes.
Because a lot of their out-of-pocket translate into charity care as well.
It's about co-pays.
Yeah, health exchange patients, when you look, because we can look at it on charges, we look at it on the number of unique patients as well. And the health exchange was about 2% of patients back in 21. It's now getting close to 7 or 8% of patients. So it is a growing number. And the amount of write-offs connected to charity or bad debt connected to that group is also growing substantially. All right, next slide. Okay, so this is our statement of revenue, expense, and change in net position. This is for the 6 months ended June 30th, so this is our year-to-date statement. You can see total net patient revenue is lagging behind a bit. It's 707 million. It's about 45 million behind the budget, although it is ahead of prior year. Pharmacy revenue, you can see, is 37 million ahead of budget. It's helping to offset that quite substantially. And so for the first 6 months, 1.027 billion in total operating revenue, about 13 million behind budget. But again, it's 90 million ahead of prior year. So while we didn't get quite to our budget, the system is growing, even with the expanded charity care. On the expense side, if you drop down to the expenses, 985 million in total expenses. You know, some of the categories are under budget. Salaries and wages is behind the budget. There were a number of FTEs loaded into the budget this year that we have not filled. And really the only two categories that are over are medical supplies and pharmaceuticals, and those are connected to our volumes. So after the expenses, we get down to EBITDA, or our earnings before interest, depreciation, and amortization. So for the 6 months ended June 30th, we had 42.6 million in EBITDA compared to a target of 67, so 24 million behind the target. Again, growing, doing better than last year, but not where we need to be. The budget, for whatever questions or concerns there are, the budget target is really where we want to be. So the fact that we're behind budget is something we need to manage.
Did you give 1 minute to July?
I will. It's in the deck.
Oh, I'm sorry.
I promise.
The good news.
I'm saving the good news for last.
We skip all this, go right to July.
So you add depreciation and interest, you get down to our operating metric. Operating loss for the first 6 months, $38 million. Again, slightly better than last year. The bright spot, which Adam already alluded to, if you look at our net investment income for the first 6 months, 29.3 million. So bringing our total change in net position to 11 million. Any questions on the 6 months?
Any of the cost reduction initiatives shown up yet?
It wouldn't be in these numbers, because these are as of 6/30. I'll get to July in a minute, and there's improvement that starts to show up in that, but really the things that the system executed on are really gonna start to show up in the coming months. Because there was a reduction in force, you know, there's a severance connected to that. Will take a little time to get to where we feel the full impact of the reduction in force. Okay, next slide, please. This is the 3 months ended for the second quarter. So this is just the second quarter. And you can see here where the improvement that came in the second quarter that helped improve where we were at after the first quarter. So we did see some growth in the revenue, certainly. And you can see if you looked at net investment income, that all occurred in the second quarter. So after the second quarter, we're definitely in a better position than we were after the first quarter. Next slide. This is a statement of net position or the balance sheet. There aren't material changes in this since the year end. Just a couple of call outs. You'll see our cash and cash equivalents is up. And Adam alluded to, we liquidated some investments to bolster our cash, to make sure that we had the working capital that we needed to manage day-to-day operations, and to pay for the outpatient health center expenditures. So you see the offsetting, if you drop down to investments, you see the drop in investments there since year end. system is at 2.8 billion in assets. On the liability side, the only thing to call out is if you look at other current liabilities, it was 82 million at the end of the year. It's 102 million now, and that is the $20 million that we drew on the revolving line of credit. Total net position at the end of 6/30/25 is $370 million. Okay, next slide. So our unrestricted cash and investments trended over time. We landed at 648 million at 6/30/25. It's about $17 million down from the year end. Now it would have been lower if we would have not used the line of credit, of course. So we borrowed 20 million on the line of credit. That helps keep this cash position a little bit higher. And we do have some fairly significant receivables out there from supplemental programs. Most notably the HCAP program that has been approved. And we have paid our assessment portion to that, and that cash is due in September. That's the HCAP program. The CSIP program, there's also a receivable, but that we need approval on before we start.
I think maybe you want to explain how we give money, but we get more back.
What HCAP?
Yeah, well, there is an assessment that you pay into the program. And ours was a little over $6 million. And that's going to generate roughly $51 million in HCAP funds from the state. So the net, about $45 million. Question?
Got that.
News on CSIP.
We're all anxiously awaiting.
Every day that goes by.
Don't look behind you. All right, next page, please. Our covenant compliance, and of course, our two covenants connected to our bond offering is cash on hand. You can see we're sitting at 6/30/25. We were sitting at 117 days cash on hand with a requirement of 75, and our debt service coverage ratio was 1.61 with a requirement of 1.1. So in good standing. Next slide. Just for the committee's information, this is our capital budget summary for the past 2 years. You can see the 2024 capital was just about completely spent or committed. 2025, which is detailed down below on the page by category. You see, we still have about 48% of the fund remaining uncommitted, unspent. So the operations team have done a really good job of trying to manage that and only approve the capital that is very, very much needed, so we can try to conserve some cash on this budget as well. Okay, next slide, please. July. Yay. So, I'd be remiss if I didn't say as expected. The third quarter is normally the strongest quarter for Metro Health, and this July was no exception. You can see, 486 million in gross, 17 million better than budget, almost 47.5 million better than prior year. Really strong month. That turned into 126 million in net patient revenue compared to a budget of 128. Still pretty close to hitting the budget. The increase in charity care is not only an increase, it was actually above. It's an increase above what we budgeted. So that did hurt that a little bit. But then other revenue was right on track. And again, without fail, the retail contract pharmacy revenue beat the budget by almost $8 million. All in 183.7 million. In revenue, 5.6 better than budget and 15 million better than prior July. Expenses also were really good, actually under budget for the month by $1 million. And the only two places where we ran over were medical supplies and pharmaceuticals. And that's very much connected to the increased volumes that we saw in July and the retail sales. So a $4.6 million operating income for the month of July, which is just great. 6.6 million ahead of budget and 1.8 better than prior year. So we added 18.27 million to the EBITDA. So through July, we're at almost $61 million in EBITDA. Still running a $34 million operating loss, but it shrunk from the 630 number. Any questions on July?
July, anybody? No?
All right, everything else is in the appendix, but that concludes my planning remarks.
Thank you, Jeff. Any other final questions? We're gonna move on. We're gonna ask for a resolution. And thanks, Jeff, for that. This resolution has to do with recommendation to use remaining series 2017 bond proceeds to capital expenditure for the system's APAC project. Were previously approved by the Board of Resolutions 19477, 19526, and 19655. Jeff, I'm gonna turn it back over to you and kind of give a detail of how much money was left over and how much is going this and what it's going to.
Okay, thank you. Well, so just to start and to maybe level set for everyone in the room, we issued $947 million in hospital revenue bonds in 2017 for the transformation project to build the new hospital and a few other things that were included in that. We have paid off everything connected to that transformation project through the last 2 months, and there is one payment remaining for Turner, who was the project manager. That payment is $1.7 million, roughly $1.7 million. There's $11.8 million in the bond fund. So that means when we make the final payment for that project, there would be $10 million, roughly $10.3 million remaining in the bond fund. And what we are recommending to the committee to approve is that we draw down that final $10.3 million to reimburse the hospital for expenditures on the Apex project or the outpatient health center. And so legal review, internal legal review, external legal review, bond counsel have reviewed all the documentation that we have, and that the expenditures connected to the outpatient health center are within the bounds of the originally issued bond documents as a reimbursable expense, an expense that is valid against the bond funds that we issue. So our recommendation is to draw down that final $10.3 million to reimburse the health system for expenditures already made on the outpatient health. Any questions?
Was this 10.3 part of the original capital stack a year ago? I don't think it was. I thought we were gonna be using a line of credit to finish this job.
To finish the outpatient health center? So there was talk last year, as I understand it, that we were gonna continue to draw money against our line of credit to make the payments for the project, the outpatient health center project, and then in 2026 to reimburse ourselves by issuing debt. That option is still on the table, but that option will become much more difficult now that we've had a bond downgrade. So it will make it a more expensive option. It's still an option. But it's only one option. So when you say in the stack, this money, I'm not sure what other people thought about it or what they wanted to do with it, or if they had plans for it, but essentially it's just reimbursing ourselves for expenses that we've already paid in cash for the outpatient health center. We've borrowed only 20 million on that line of credit. So we haven't drawn anywhere near the total amount that we could,
You're talking about the key bank line,
the
okay?
key bank line of credit.
But if I remember correctly, we have about 134 million to fund, correct, for Apex, something in that range?
We did at that time. Now I think we're down close to the 67 million, I think is the last number I saw.
Do you remember, we authorized like to 130 million
Right.
to use that to do Apex.
Yes,
Right.
Yes, yeah.
That's what I'm recalling.
yes, yes. That was authorized, but the plan to execute that was in next year in 2026, after the project was completed.
So this 10.3 million would address the remaining 67 to the degree it does. We still have a gap.
Yes, yes.
Still have a gap.
And we still want to talk about what's the right thing to do, whether it's to issue debt and put more cash on the balance sheet, or pay for it out of cash and, you know, as we have now. We are paying out of cash either way, or the line, and then we would reimburse ourselves if we issue debt next year. But that is still a question for.
So we're gonna do it, and then we're gonna figure out,
What's the best way to,
right,
Pay for
either, we just eat it, use our cash, and that's it, or we talk about, should we, yeah.
Those are the options, and certainly, you know, we're gonna seek counsel from Kaufman Hall, our financial advisors, to help us with that. Position the health system in the strongest possible situation on the balance sheet and in our operating statement.
So when you mentioned that we would issue debt, would that be bond anticipation notes or short-term notes to get us
It
through?
probably would be long-term debt.
So we'll go right to long-term.
I would think so, yeah. Yeah.
Just keep in mind, we're in executive, we're not in executive session. Okay.
Got in the weeds.
Keep us in line.
Yeah.
Any other questions on financial reports? Okay, so I'm gonna ask for a motion okay, we don't, do we do I recommend, do we do a motion on this bond, right?
Yes, yes, motion to approve, so it says, are there
Yeah,
any
yeah,
additional
there it
comments?
is. Do I have a motion for? Do I have a motion for approval of the capital expenditure? $3 million.
10.3 to reimburse them.
To
reimburse ourselves.
Yes, to reimburse proceeds from the capital, bond proceeds from the capital expenditure for the system, the Apex project.
So moved.
Second.
All those in favor?
Aye.
Any nays? Any abstention? Motion passes. Thank you. This time, we're going to move into executive session, discuss hospital trade secrets as defined by ORC 1333.61. Do I have a motion to move into executive session, discuss these matters?
So moved.
Second,
Second.
all those in favor?
Yes, just do a roll call.
You do roll call. Mr. Arnold?
Yes.
Oh, there you are.
Just hold on, yeah. Thought I was throwing my voice.
Ms. Corvette?
Yes.
Dumas?
Yes.
Ron D?
Join.
Ms. Garcia?
Come back to her. She just stepped out.
Okay. Mr. Jacobs?
Not here.
Ms. Mendez? Myself, yes. Mr. Summers?
Aye.
And Dr. Walker?
Yes.
We are now going into executive session.
More question to Jeff? I'm asking if there are more questions to Jeff after.
Oh, yeah. Let me know when I can Let me know when I can share.
You should be able to, hold on.
Back in public session. Back in public session, the time is 3:00, and for no other further business, this meeting is adjourned. Thank you.
It's a great meeting, John.